Hi everyone, welcome once again to our Jahangir tutorials channel. Today as decided, as I had already informed, that I will be revising next two chapters, important chapters of Financial Management CS Executive Module 2, our MCQ paper. Okay, we have already, I have already done with you all cost of capital. In case you all want to refer cost of capital and leverages, leverage is also part of capital structure. Okay, so for that you can definitely go ahead and see my video which was there for the same. Okay, also in case you all have not joined my telegram group and the WhatsApp group, do it now so that you can keep yourself posted with all the revision lectures and other type of small short videos which we come up in order to help you for your exams. Okay, so let's begin. Okay, capital structure. Okay, now capital structure, when you see from the financial management point of view, or when I'm talking about capital structure from a company point of view. Okay, from a company point of view. So think about the company. Now, when a company, when a company is incorporated, there is some kind of capital which is already subscribed, okay, by the subscribers of MOA. Then there are other, that is equity share capital in the form of capital, equity share capital. So we'll find major portion of the entire capital in a given organization, which will be in the form of equity share capital, which is known as the own capital, own funds. Okay, then we have other sources in the form of debt. We can have preference share capital. We can have some kind of a loan taken from the bank as and when the company needs a particular capital for an investment of, in their particular organization. Then the company will decide on which form or which source we should take up in order to raise this additional funds. Now, how is that decision taken? Okay, just randomly, they just don't one day say that, okay, now we need more funds, equity share capital we will issue. No, there are certain things which has to be assessed in the company, which has to be assessed from the shareholders' point of view also. Okay, they are the owners of the company. Okay, they are the ones who had given us the capital at the time when we began. Okay, so equity share capital belongs to our shareholders. So we also have to think from the shareholders' point of view. So what is that? In order to understand that entire capital structure, okay, we have to understand the earnings of the company. How much is the company earning? Okay, how much is the earning per share to the shareholders? Okay, in that case, whichever source we raise our additional funds with, if that particular source is keeping our shareholders happy, okay, why will they be happy? Because of that source, your earning per share is higher. Obviously my shareholders will be happy, and then there will be no problem in passing the resolution for having these additional funds raised from a given particular source. Okay, so capital structure means the breakup of the entire capital employed by a firm. Okay, so capital employed consists of both owner's capital, as I told you, equity share capital, preference share capital, and debt capital provided by the lenders. Okay, so now there is a financial strategy based on which they will use these sources for the financial expansion, etc. And there are various kinds of capital structure. One is horizontal, where the firm has zero debt. They are all reliable on equity share capital only. Then there is a vertical capital structure in which there is very small amount of equity share capital, and anytime additional funds is needed, it is always through loan or always through a debt. Then there is a pyramid shaped capital structure. They have a large portion of equity share capital. Also, they have a large portion of their own retained earnings, and which they again bring it back and put that only funds and expand and invest in the given project. Okay, and we have inverted pyramid shaped capital structure. Again, here they have a small component of equity share capital and they have an ever increasing component of debt. Okay, it is highly vulnerable to collapse because there are a lot of creditors in the given firm. Okay, now significance of the capital structure. Why is this important? It will reflect the firm strategy. Okay, risk profile is assessed. It is a management tool and it improves the image of the firm. We are concerned, okay, from your exam point of view, we are concerned in order to understand what is the most best and optimal capital structure, which will be a combination of equity, of own, of debt, etc. A combination less or more than optimal combination would be less than satisfying. So we need to have an optimal combination to satisfy our shareholders and in the same time also help the company to invest in the best manner. Okay. So the optimal capital structure is the one which offers balance between debt to equity range and therefore minimizes the firm's cost of capital. Okay, so they have to think from the company's point of view also and keep our shareholders happy. Okay. Now coming to capital structure theories, on which all the practical sums are based of this chapter. Okay, we are going to do net income approach, net operating income approach. There is a Modigliani and Miller approach as well. As and when I will solve the few sums, the type wise sums, there are basic sums going from one type to another. You will be able to understand. Okay. So coming to EBIT, as I told you, earning per share analysis is the best way. Okay, in order to understand which will be the most effective and the most optimal capital structure. Okay, so here in this chapter, even in the exam questions, you will find there are questions in which they are asking you to find earning before interest and tax, or they are asking you to find earning per share. Okay, given number of shares, giving you the earnings, they are asking you to find the earning per share. So we are supposed to know this. So thus EBIT-EPS analysis is an effective method in analyzing the effect of leverage. Okay, leverage is in the time you take a particular debt. Okay, and how leverages the firm, risk protection to the shareholders, earning per share is increasing, not increasing, declining. All this is analyzed with the help of finding the earning per share. Okay, so what are we going to do in today's topic? We are going to evaluate various options which are there to raise money. Secondly, we are also going to have the best benefit option, where the benefit is the best for the equity shareholders. We will also analyze that. Okay, so now in this particular sum or in this type, they will give us the present capital structure, additional funds which we'll need, then choosing the correct option to raise the funds. Now, the correct option can be either do an equity, or you do debentures or preference shares, or you have a mixture of all. Okay, that we will have to decide. Okay, when I will solve this sum, please you all also solve it along with me. Okay, try to see that even you all are, so you will get a practice. As and when I always keep telling you, it is very important for you all to practice, and this is the right time. Okay, in this 2 hours, okay, 2 or 2.5 hours of the lecture which I am taking, I am revising 2 chapters. Your 10 to 12 marks are secured. Okay, so please see that you can solve along with me. Okay, your revision will be done. Let's read this particular question. Okay, now AB is a very easy one, the basic one, simple. And trust me, these type of basic ones are also asked in your MCQ. So your 1 mark is like just half a minute away, 30 seconds away. Okay. ABC Limited has an equity capital of rupees 5 lakhs. The face value is rupees 100. That means this company has 5,000 equity shares. Okay. To meet the expenditure of an expansion program, the company wishes to raise additional 3 lakhs. Now they have given 4 alternative sources to raise the funds. Either they can have full money in the form of equity shares, to have 1 lakh from equity, and then the balance 2 lakhs they can take a borrowing as a 10% per annum will be the interest in that. Or else they can take full money from in the form of borrowing, And the last one option is 1 lakh they can take in form of equity and the balance 2 lakhs in the form of preference shares, wherein the dividend will be 8% per annum. The company is having present NPBIT, EBIT or NPBIT is the same, earning before interest and tax or net profit before interest and tax is rupees 1,50,000. Okay. Corporate tax rate is 50%. Suggest the suitable option to raise the funds. Okay, let's begin. I am going to I am going to do the solving on the other side. So I'll write the given, don't worry. Okay. So your question number 1, ABC Limited. Now, particulars. I'm making some columns. Particulars. Then we have 4 options to analyze. Okay, so we have option 1, option 2, there are 4 options. 1, 2, 3 and option number 4. And particulars. To begin with, I'm going to start with NPBIT. Okay. Net profit before interest and tax. What is their NPBIT? The company having present NPBIT earnings of rupees 1,50,000. Okay. And the corporate tax rate is 50%. Alright. Now here, one just small working note I have to first make y'all. Whenever I am writing net profit before interest and tax, I will always need a revised one. Okay, revised. I cannot write NPBIT 1,50,000 because that net profit was based on their existing capital structure of that 5 lakh rupees. Okay. I need more additional 3 lakhs rupees. So in the future, what will be my NPBIT? I need to analyze that first. Okay. So come here. See in the question, NPBIT is 1,50,000. So present. Okay. Present. Capital employed and NPBIT. My capital employed is 5 lakh rupees and my NPBIT is 1,50,000. So if I want to see what is my return on capital employed, okay, my return on capital employed is nothing but 30%. Okay, 30% is my return on the capital employed present. How did I get this 30%? Of course, 1,50,000 divided by 5 lakhs. Okay, in the form of percentage. How much is my NPBIT to my capital employed into 100? Okay, I have to keep the same return. I have to keep the same return on my revised or new additional funds with my revised capital employed. Capital employed now revised is going to be 8 lakhs. So my new NPBIT or revised NPBIT will be 30% of 8 lakhs, which is going to be 2,40,000. So now with 2,40,000, I am going to start my sum with in order and then find out which option is the best to raise the funds. Okay. Now NPBIT revised, I am writing everywhere same 2,40,000. Okay. Two lakh 40,000. From there, I have to subtract my interest. Okay, now there are in the options, if you see, option 1 is totally, okay, full money is from equity shares. Okay, and currently also they are having equity shares only. So there is no debt. Full is from equity shares. Next is 2 lakhs is from the borrowings. Then full money is from the borrowings, and the last is 1 lakh equity and 2 lakhs of preference shares. So I am just writing this. This is full equity. Then we have 1 lakh equity and 2 lakh borrowing. So here 1 lakh equity, 2 lakhs borrowing. Then we have full borrowing. And here again 1 lakh we have equity. And we have 2 lakhs of preference shares. Okay, so these are the options. Okay, borrowings rate is 10% per annum and preference shares dividend rate is 8% per annum. Now once I have written all this given, only then my sum will become very easy to solve. Okay, additional funds which I need is going to be 3 lakhs rupees. Now in the first case there will be no interest. Okay, because it is completely equity, there is no debt, there cannot be any interest. In the second one, there is 2 lakhs of borrowings. Okay, the rate of interest is at the rate of 10% here. So 20,000. Okay, 2 lakhs into 10%, 20,000. Full borrowing. Okay, option 3 is full borrowing, means my entire 3 lakhs. Okay, total 3 lakhs is going to be borrowed. So 3 lakhs into 10%, that will become 30,000. Again, in the last option, there is no debt, so there will be no interest. Okay, now coming to net profit before tax. This is the simple income statement I am making. That's it. Okay, and when we solve these type of lengthy sums, okay, some people find them that they are lengthy. We have MCQ, but all these type of big sums makes all your concepts clear. Okay, so in the form of MCQ, you might be asked for me any one option, but I am doing all the 4 so that if tomorrow any question is asked, you will not get stuck. Okay, so net profit before tax is going to be here 2 lakh 40. This is going to be 2 lakh 20,000, 2 lakh 10,000, and here again 2 lakh 40,000. They are giving me the tax rate which is 50%. Okay, so 1 lakh 20, 1 lakh 10,000. Here 1 lakh 5,000 and again here 1 lakh 20,000. Okay, so tax rate 50%. So net profit after tax. Net profit after tax will be the remaining 50%. Okay, clear? 1 lakh 20. Last option also. Net profit after tax. Now we have to first remove our preference dividend. Why? Because preference shareholders get a, they have they are supposed to be paid dividend before dividend is paid to equity shareholders. Okay, so here we are going to first deduct the preference dividend in order to know what is the amount which is left with our equity shareholders. They always have a preference in the dividend is paid. Preference dividend is not there in my option 1. It's not there in my option 2. It is also not there in my option 3. It is just there in my last option. 2 lakhs of preference share capital at the rate of 8% is my dividend. Okay, so 16,000 will be my dividend in the last option. So now whatever profit I am left with, it is known as net profit for equity shareholders. 1,20,000, 1,10,000, 1,05,000, and here it is going to be 1,04,000. Okay. I have to divide this net profit with number of equity shares. Why so? Only then I will get earning per share. What is the formula for earning per share? Net profit for equity shareholders. Sorry. Net profit for equity shareholders divided by number of equity shares. Okay, that is the formula for earning per share. So let's see in our first option, how many equity shares do I have? I have total of 8,000 shares. Now how? How 8,000? 5,000 already were existing plus new 3,000 I have issued. 100 rupees is the face value. Face value is 100 rupees. Okay. Existing shares, number of shares are already 5,000. So whenever I am issuing new ones, I have to take that into my consideration. Okay. So 8,000 in the first place. In the second one, there will be only 6,000 shares. Why? Because 5,000 existing and remaining only 1 lakh I have formed in the equity. So 1,000 shares additional. 1 lakh divided by 100. Next, there is full borrowings. So only existing shares. And again here it will be only 6,000. Why? Because 5,000 were the existing and only 1 lakh. I'm sorry, you all could not see. Only 1 lakh I have taken as in the form of equity. So 1,000 equity shares. Therefore, earning per share in this case will be rupees 15. Here it is going to be rupees 18.33, rupees 21 and rupees 17.33. Okay. So here the earning per share in option 3 is the highest, where there is additional funds only taken in the form of debt. Okay. So option 3 only debt is the most optimal option for raising additional funds. Clear? Okay, so in this sum there were 4 concepts, okay, which we have covered. Now how? Just quickly, I'll just revise quickly, these 4 concepts, okay, so you don't have to mug it up. First one, we found how to find the revised NPBIT. How did I get my revised NPBIT? With the help of the current capital employed and the net profit earned by the company, I got my rate of return. Using that same rate of return with the new capital employed, revised capital employed, I get my new NPBIT, concept 1. Second, okay, from your entire net profit after tax, okay, until there we know first. After that, then we need to subtract our preference dividend. Okay, only then we will arrive at a net profit for equity shareholders. Then how to find earning per share? Okay, earning per share with the help of the new number of shares as well. Okay, so net profit for equity shareholders done. Earning per share is done, and with the help of that we come to know that which will be our most optimal option to raise these additional funds. Okay, now let's go to sum number 2. Okay. Now this question number 2, I have not come across any kind of an MCQ still on this particular formula. But I will just like to explain you all this in case if they happen to ask. What is this? It is that capital structure. Okay. It is that capital structure. Okay. It can be two different types of capital structure I am analyzing. But after analyzing, I come to know that whatever it is, both the earning per share in both the options remain the same. Okay, indifference point. Indifference point is that level of NPBIT or EBIT, that amount of EBIT in which whatever is the form or the source or different optimal structure, etc., my EPS will remain the same. Okay, so I should earn that much of EBIT so that my EPS will come same, come what may, or be the capital structure in that case. Okay, so let's see, we will just solve one sum in order to understand this particular formula. Okay, what does this formula say? Earning per share is the same, earning per share in option 1 is the same as earning per share in given option 2. Now, how do I find earning per share? Earning per share is nothing but EBIT minus interest into 1 minus tax rate minus preference. This is the same thing which we arrive from the income statement upon n, number of shares. Same thing, this formula. Only one formula you need to know. Okay, we have to equalize it, put it in the form of an equation and find that level of EBIT. Now how? We will just see. So there is a new project. They require a capital outlay of rupees 300 lakhs. The required funds can be raised either by full equity share, one share of rupees 100 each, okay, or equity shares of rupees 200 lakhs, where 100 each is again the value, but 200 lakhs in form of equity and balance 100 in form of loan, 15% interest. Tax rate is 50%. Calculate the profit before tax that will keep the equity investors indifferent. They will tell you, okay, you can select any option you want because their earning per share is not getting affected. Okay, so we have to calculate the earning per share. So I'm writing here, this is equity, this is the debt. Option 1, option 2. Okay, here I have to see that my earning per share of this option is the same as earning per share 2. Okay, now I'm just writing the formula EBIT minus interest into 1 minus tax rate, okay, minus preference dividend upon n. Same thing, EBIT minus interest into 1 minus tax rate minus preference dividend, the whole thing upon. Okay, now in the first one, okay, we have to find the EBIT. Okay, so EBIT we will keep it as it is. In the first option, since the entire thing we want in the form of equity, there is no interest. So interest will be 0. 1 minus tax rate is 50%. I am writing as 0.50. There is no preference dividend again in this sum 0. So n number of equity shares will now be, okay, 300 lakhs we need. Fully equity 100 rupees is the value. So number of shares will be 3 lakhs. Next, EBIT. But here there is interest. How much is the interest? On 100 lakhs rupees of loan, I am giving 15% interest. That means it is going to be 15 lakhs. Okay. 1 minus tax rate. There is no preference dividend. Okay, there is no preference dividend. And here it is going to be how many? Equity shares only 2 lakhs. Why? Because 1 lakh is 100 lakhs is from debt. Only 200 lakhs is in the form of equity. So 200 lakhs divided by 100. Face value of the share, 2 lakhs. Okay. So here it will become 0.5 of EBIT. Here it will become 0.5 EBIT minus 7,50,000. Okay, here you can just make it 3 and here you can make it 2. You can cancel the zeros. Okay. Then when you solve this further, I'm just taking it on the next page. Okay, I'm writing it here. EBIT will then be okay. You can just do one thing. I'll just put this again. 0.5 EBIT upon 2. This will be equal to again 0.5 EBIT minus 7,50,000 upon, this is upon 3, this is upon 2. Now take the 2 here, 0.5 EBIT and 3 we'll multiply here. Okay. So now we will resolve this. This will become 1 EBIT. Okay. 1.5 EBIT minus 3 into 7,50,000. That will be 22,50,000. It is very important to solve this correctly. Okay. Now I am taking 22,50,000 on this side. So from minus it is going to become positive. Okay. And 1.5 EBIT minus 1 EBIT is again going to become 0.5 of EBIT. Now divide your 22,50,000 by 0.5. You will get EBIT. Okay, it is going to be 45 lakhs. Answer is 45 lakhs. There are chances of these type of question to be asked in the MCQ to find the EBIT given these two options. There will be nothing much difficult in this. This is what are they going to ask. But solve this correctly in the form of equation. See to it that you put the correct subtraction sign, addition sign. You are taking the correct figures on the other side of the equation and then you solve it. Okay, so EBIT is going to be 45 lakhs. Simple. Okay, so this was another type. Next type, when we will solve the exam questions, it's going to be fun because they are very, very easy. Okay, now there is one new word, financial break-even point. Okay, now this financial break-even point, if you will see certain sums are there in your chapter number 1. Okay, Introduction to Financial Management. Even in that, since they have explained certain concepts based on financial management, they are asking you some 1 to some here and there based on that. Okay, so there is one additional formula. It is covered in capital structure also. So I am just sharing that with you. If you are able to do this type of simple sums and if they come for 1 mark, it's going to help you a lot. Okay, and there is it's not difficult at all. Now what is a financial break-even point? Okay, what is a break-even point? Yesterday also I was explaining all the same thing in leverages. Okay, break-even point is that amount of profit. Break-even is that amount of that level where there is no profit and there is no loss and no profit. Okay, no loss and no profit. As per the financial break-even point, what is the formula they are giving? They are saying financial break-even point is nothing but interest. Okay, which we have to provide to our lenders. plus preference dividend. With that dividend, DDT also sometimes we have. Also sometimes we transfer the funds, okay, the balance funds to either reserves or to sinking funds, etc. The whole thing divided by 1 minus tax rate. Okay, this will help. This is the easy way of finding the financial break even instead of making the entire income statement. It is derived from the income statement itself. Okay, whatever we are doing, no EBIT minus interest, then from there, but here we are going in the opposite manner because we have to arrive to that profit where it will be 0. Okay, now let's see. 10,000 equity shares, 10% preference shares of rupees 3,50,000, tax rate is 50%, 10% debentures of rupees 5 lakhs, DDT is 20%, transfer to the sinking fund is 28,000 per annum, calculate the financial break-even point. Okay, fine. So, financial break-even point is nothing but your only interest plus preference dividend. Now, what will be my interest? Interest will be nothing but your 10% on my 5 lakhs rupees of debentures. So, 50,000. Okay, plus preference dividend is going to be 10% of 3,50,000. So, that is going to be 35,000. Plus, I have a DDT right now. Have they told me? Yes, it is 20%. Okay. So, I am going to do 20% of my dividend amount, 35,000. Plus, transfer to the sinking fund is 28,000. This I have to divide it by 1 minus tax rate. Okay, I am just putting this bracket here. 50,000 plus this will be 35,000 plus 35,000 into 20%, which is going to be 7,000 plus 28,000 divide by 1 minus 0.30, 0.7. This is going to be 50,000 plus add up all 35,000 plus 7,000 plus 28,000. It is 70,000 divided by 0.7. Okay, that is going to become 1 lakh. So 50,000 plus 1 lakh. 1,50,000. Okay, so 1,50,000 is your financial break-even point. Okay, if you will get your, you have to arrive at an EBIT of 1,50,000 when you will start giving your preference dividend and interest and tax, etc. You will be left with a 0 amount at the end. Okay, so that is known as financial break-even point, one simple formula. Correct. Now going to important theory. Okay, net income approach, net operating income approach. Okay, the theories which help us to find the market value of the firm. Okay, now this particular theories, okay, they have 3 common assumptions. Okay, in order to find the market value of the firm, we have to use these theories. These theories have, okay, the theories which I showed you in the starting, net income approach. Then we have net operating income approach. Okay, then we have Modigliani and Miller approach, M&M. Okay, now all these theories, there are certain assumptions wherein they are saying that there will be no tax, there is no growth, and there are only 2 sources of finance, one is debt and one is equity. So if I want to find tomorrow what is the market value of the firm, very simple. For us, market value will be market value of our equity plus the market value of our debt. There are two easy and simple formulas to find both. What is market value of equity? It is nothing but net profit available for equity shareholders upon the cost of equity, KE. And market value of the debt is what we give to them. We give them interest upon the cost of debt. Okay, so market value of the firm will be this. Also, the entire cost of capital, okay, the total cost of capital, including both equity and debt, KO. How do I find KO? KO is nothing but the earnings before interest and tax upon the market value of the firm. Okay, I have to use all these formulas. There are MCQs based on all these formulas only. Okay, find the market value of equity, find the market value of the firm, find the market value of the debt, what will be the amount of KO, etc. Okay, percentage of KO, percentage of KE. That is what they are asking from this chapter. So basically this last section is the most important one. Concentrate, solve along with me. Okay, and then we are moving to the exam questions. Okay. Coming to this question number 4. Assuming that there is no tax. Interest is 12.5%. Calculate the market value of the firm A, B, C and D from the following data. Okay. Let's start. Okay. Question number 4. We have to find the market value of all the 4 firms. Okay, so particulars. We have firm A, B, C and D. Okay, I'm just taking all the information and putting it here. First, I will need my EBIT. So, all the 4 firms EBIT 3 lakhs, 4 lakhs, 6 lakhs, 7 lakhs. Okay. EBIT or NPBIT, whatever you can write. 3 lakhs, 4 lakhs, 6 lakhs, 7 lakhs. I have to subtract interest. How much is the interest? They have already calculated that 30, 70, 3 lakh and 3 lakh 40. Okay, they have calculated that for me. 30,000, 70,000, 3 lakhs and 3 lakh 40,000. Earnings after tax, or you can just directly write your net profit for equity shareholders, because there are only 2 sources of finance. There is no preference dividend, debt and equity. So this profit which is left is for equity shareholders. So net profit for equity shareholders 2,70,000. Then we have 3,30,000. Here we have 3 lakhs and here we have 3,60,000. Okay, I have to find the market value of the firm. I'll come to it. They have given me equity capitalization rate. Equity capitalization rate is nothing but KE. And they have given me KD. Both are given to me. 12.5% is KD. And equity capitalization rate, obviously, it varies from one firm to another. So, I will just write over here KE first. Okay, KE. Of all the 4 firms, A is 12%, B is 15%, C is again 15% and D is 18%. Once I know my KE, I know my net profit for equity shareholders, I can find market value of equity. How? Net profit for equity shareholders upon KE. So 2,70,000 divided by 12%. 2,70,000 divided by 12%. It will be 22,50,000. 3 lakh 30 divided by 15%, it will come as 22 lakhs. 3 lakh 30 divided by 15%, 22 lakhs. 3 lakhs divided by 15%, here it will come as 20 lakhs. And 3 lakh 60 divided by 20% is again going to come as 20 lakhs. Okay. Market value of equity is done. I'm just highlighting market value of equity. Okay, now they have given me KD. KD is 12.5%. Okay. Now since I have KD, I also have interest with me here. I can find market value of the debt. Market value of debt will be nothing but interest, total interest upon the KD. So in my first firm, interest is 30,000. So I will do 30,000 divided by 12.5%. It will come to 2,40,000. Then 70,000 divided by 12.5%, it will come as 5,60,000. Then 3 lakhs is the interest amount divided by 12.5%. It will come as 24 lakhs. And then again 3,40,000 divided by 12.5%. Okay, 3,40,000 divided by 12.5% will come as 27,20,000. Okay, so now I have my market value of debt also with me. I have already found market value of my equity. I have to just add up market value of equity plus market value of debt. That will give me my market value of the firm. Market value of the debt. Equity plus debt. In the first case, it is going to be 24,90,000. Next, 27,60,000. Just you have to add up the ones which I have highlighted. 20 lakhs plus 24 lakhs. It's going to be 44 lakhs. And here it is going to be 47,20,000. Okay, so market value of the firm is arrived. Okay, we have already calculated market value of the firm. Now say if I go one step ahead and I ask you that what is the total cost of capital or overall cost of capital in simple words. Okay, I just need one more thing. I am asking what is total cost of capital? What is the percentage? I can just put here NPBIT. Okay, I just gave you all the formula, right? NPBIT upon the market value of the firm. I'll multiply that by 100. It will come in the form of percentage. I need the KO for all the 4 firms. Okay, I have the NPBIT of all the 4 firms. I also know now the market value of all the 4 firms. It is very easy to find. In the first case, it will come as 12.048%. Next is 14.49%, 13.64%, and 14.83%. How did I get that? NPBIT 3 lakhs divided by market value of the firm to 24,90,000. I'll just highlight this. NPBIT divided by market value of the firm into 100. When you will do, you will get the percentage of your overall cost of capital. Clear? So in this sum is very, very important. There are 3-4 formulas all together in this particular sums. Most of your MCQs also are based on this sum itself. Okay. So now let's move forward. Now market value of the firm as per net income approach and net operating income approach and other models. Okay. Now let's see what is this. There is two companies. Same thing. Okay. We are doing again on the same formulas. Market value of the firm and market value of the equity. Just one additional thing I will tell you, since we are doing these two models, net income approach and net operating income approach. Just write it down. In case of net income approach, okay, in case of net income approach, always KE is constant. KE does not change. KE remains constant. Okay, of the firms, both the firms, it will remain the same. Okay, this is one additional assumption, or this is one additional derivation and the theory. Okay, in case of net income approach, KE remains the constant. And in case of net operating income approach, net operating approach, here KO will remain constant. We will have to use this. Why? Because they will not give us one particular variable. So when we have to find that, we need to know which approach we are doing, and in that what is going to be constant. With the help of that only we will be able to solve the problem. Okay, so let's see. Company X and company Y are in the same risk class, identical in all aspects, except that company X uses debt while company Y does not use any debt. Leverage company, the one which uses a debt, is known as a leverage company. Uses debt. Has rupees 9 lakhs debentures carrying 10% rate of interest. Each company is earning 20% before interest and tax on their total assets of rupees 18 lakhs. Tax rate is 50%. KE in all equity company, all equity, where there is no leverage, where there is no debt, okay, is 18%. Calculate value of both the companies as per net operating approach and net income approach. Okay, first I am doing net operating approach here. Okay, I will just solve it here. Question number 5. Okay, net operating approach, NOI. Okay, in case of NOI, I have told you what is going to be constant over here. Here KO will be constant. KO is constant. Okay. There are two companies. So particulars, company X and we have company Y. Alright. Company X uses both. They use debt. They have also equity. Okay, they are leveraged. They are leveraged by using 9 lakhs of debt at the rate of 10% is the interest. Okay, and they have 9 lakhs of equity. Okay, they have 9 lakhs of equity. Now how I came to know? 9 lakhs of equity because total assets is 18 lakhs. Total assets. They have not given me the breakup, but they have told me total assets of rupees 18 lakhs. So obviously equity assets is equal to liability. Total. So I have in the form of assets they have given. So total is 18 lakhs. Of course, debt is 9. Equity is going to be 9. In company Y, which is an all equity company, there is no debt. So total here directly it is 18 lakhs. Okay. Now going ahead, net profit before interest and tax. Okay, they are telling me that they have given me the percentage. Earning before interest and taxes 20% on their total assets. So 20% on 18 lakhs. Okay. For both it is going to be at the rate of 20% EBIT. So same 3 lakh 60, 3 lakh 60 minus interest. Okay, in the first case, yes, I will have 9,000 rupees as interest to be subtracted. No, sorry, 90,000, 10% of 9 lakhs. 90,000 to be subtracted, here there will be nothing. So net profit before tax, or I can just directly write net profit for equity shareholders. Okay, net profit for equity shareholders 3,60,000 in company Y, and here it is going to be 2,70,000. Okay. Now I have got my net profit for equity shareholders. I also want to find the market value of equity, but I do not have KE. No problem. I will go ahead first with, okay, I will just keep here KE I have to find. Once I know my KE, I will know my market value of equity also. Okay, we will come to it. I am just putting my KD. KD in the first company is 10% debt rate. 10%. Okay, so say here also 10%. Market value of the debt. Okay, your market value of the debt will be nothing but the same, 9 lakhs rupees. No? 90,000 divided by 10%, 9 lakhs. This is going to be nil. There is nothing. Market value of the debt will not be there. Okay. I also know I have to now see my market value of the firm. Okay, market value of debt, market value of equity will give me my market value of the firm. But I am not, I have yet not find my market value of equity. But in case of the net operating approach, I know one thing, that KO remains constant. Okay, KO will remain constant. So what is my KO? KE in all equity company is 18%. Okay, KE is same in the all equity company, it is 18%. So here I have got this as 18%. Okay, with 18% in KE. Okay, I have net profit for equity shareholders 3,60,000. With that, okay, market value of equity is nothing but net profit for equity shareholders divided by KE. I can easily find this market value of the equity is 20 lakhs. Okay, once I got the market value of equity, market value of the debt we all know in case of company Y is nil. So when I will add up, my market value of the firm is going to come to 20 lakhs only. I have already found the market value of the firm for company Y. With the help of that, can I find my KO? KO is nothing but NPBIT upon market value of the firm into 100. For company Y, I have got NPBIT, which is 3,60,000. I also know the market value of the firm. So when I will calculate, it will come to 18%. Okay, how did this come? 3,60,000 is my NPBIT. Market value of the firm is 20 lakhs into 100. Try do it. 3,60,000 divided by 20 lakhs percentage, 18%. I have arrived with my KO. In case of net operating approach, KO remains constant in two given companies which are same in all the aspects. Okay. So here, since it is 18%, now this is also going to become 18%. So now I know my KO. With the help of my KO, can I find my market value of the firm? Yes, I can find the market value of the firm for company X. See, KO is equal to NPBIT upon the market value of the firm. Okay. Market value of the firm is nothing but NPBIT upon KO. NPBIT again I know it is 3,60,000, same 3,60,000. Okay, KO is 18% I have done over here, right? So market value of the firm again it is going to come here as, I'm writing it in red pen, it is going to be 20 lakhs. Okay, 20 lakhs. With the help of market value of the firm, now I will be able to find the market value of the equity. How? Because I have the market value of the debt. I have the market value of the firm total. So market value of the equity will be the balance one. So it is going to be 11 lakhs. Okay, 20 lakhs minus 9 lakhs, 11 lakhs. I have now got my market value of equity also in place. So now what will be my KE? Okay, so here, okay, these are all working notes. You can write this down if you want. These are all working notes for additional understanding. Okay, so my KE. KE is nothing but net profit for equity shareholders upon market value of equity. I know the market value of equity. I know net profit for equity shareholders also. So net profit for equity shareholders in my first company is 2,70,000 and market value came to 11 lakhs. Okay, in form of percentage. So 2,70,000 divided by 11 lakhs. It will come to 24 point some 54%. 24.54%. So you see how I have gone from company Y, taking the help of the KE given of company Y, I found the market value of the debt. I got the market value of equity, market debt is not there only in company Y. I could find the market value of the firm. Based on the market value of the firm of Y, I was able to find KO, the total overall cost of capital. Net operating approach, there is one more theory, concept, assumption wherein they say KO remains constant. Since KO remains constant, I have used KO 18% in order to find the market value of the firm, then gone ahead and found the market value of equity and then came to KE. Okay, now this type of sums are there in your past exam questions. We will be solving it right now, so you will come to know. Okay, so this was net operating approach. Now the next part is net income approach. Question number 5 only. Net income approach. Here KE is constant. Okay, so quickly company X and company Y. Okay, I am not writing all the details again. I am directly starting with NPBIT 3,60,000. 3,60,000. We know company Y is an all equity company. This has 9 lakhs equity, 9 lakhs debt. Minus interest 90,000. Nil over here. So here 3,60,000 is the net profit for equity shareholders. And here 2,70,000 is the net profit for equity shareholders in company X. Okay, now KE. For all equity company is given 18%. In case of net income approach, KE remains constant. So therefore, this also will become 18%. Right? They have not given me for this, but since it's constant, I have taken it from company Y, which they have already provided that to me. Therefore, market value of equity in my first case will be 2,70,000 divided by 18%. It will be 15 lakhs. And this is going to be 20 lakhs. KD, here it is 10%. Nothing is there for Y. Market value of debt 9 lakhs for company X and nil for company Y. Market value of the firm. Just add up market value of equity plus market value of debt. Here it is going to be 24 lakhs. Here it is going to be 20 lakhs. I already know now my market value of the firm. I can now find my KO because I know my NPBIT also. Okay. So my KO in my company X will come to 15% and here it is going to come to 18%. Okay. I hope all these sums you all have made a note of it. Try to solve with me. It is definitely going to help you in your exams. Okay. So I want to take you all to the past exam questions and then we will have that confidence that yes, we can solve it. Okay. Easy sums. They are not as big as what ma'am was doing until now. Okay. So let's start. ABC Limited books of accounts. They showed a profit of operation from operation EBIT, earnings before depreciation and interest and tax. Okay. EBIT is nothing but earnings before depreciation, interest and tax. Okay, because these are not operating expenses for us. Depreciation, interest, tax, all non-operating expenses. Okay. So their EBIT is standing at rupees 500 lakhs. It paid a 12% on debt of rupees 1000 lakhs. Depreciation is 100 lakhs. Tax is 35%. Profit after tax will be how much? Simple. Okay. So EBIT is equal to 500 lakhs. Amount in lakhs. Okay. From that I will first minus my interest. Interest is how much? 12% on 1000 lakhs. So 120. 1000 into 12%. So EBIT is going to be 3 lakh 80. From there I am going to subtract my depreciation. So depreciation is 100. So this will come to 280. EBT, earnings before tax. From earnings before tax of 2 lakh 280, I'll subtract my tax. Tax is how much? 35%. So 280 into 35%. 98. All these amounts are in lakhs. So earnings after tax. Okay, or profit after tax is 182 lakhs. So easy, so simple. Just we had to subtract. Okay, so earnings after taxes, and it's an exam question. And there is one more such question, in another attempt. So I have not taken that because just the numbers are different. Coming to question number 2. We just did this, net income approach. Okay. Calculate the value of the firm MNP Limited according to the net income approach. The company expects a net operating income of 80,000. It has 2 lakhs 8% debenture. Equity capitalization rate is 10%. Fine. Okay. Net profit. Okay, or net operating profit. Net profit. EBIT. What we write? Net operating income. Okay, is equal to, given to me 80,000 minus interest 8% I will take on 2 lakhs. Okay, so you can write 8% of 2 lakhs, which is going to be 16,000. So net profit for equity shareholders, this is going to be 64,000. Done. Okay, now KE, equity capitalization rate they have told me is 10%. In case of net income approach, KE is constant. Net income approach, KE is constant. So market value of equity will be nothing but net profit for equity upon KE. Net profit for equity is 64,000. KE is 10%. So this will come to 6,40,000. Market value of equity is done. Market value of the debt, nothing but it is directly you can take 2 lakhs. Why? Because see, interest upon KD. Interest we just calculated 16,000. KD we know it is 8%. This will come to 2 lakhs. Okay, so 2 lakhs plus 6,40,000, 8,40,000 will be the market value of the firm. So easy, no? This is what we just did. Okay. Next sum. Net operating income is 1 lakh. It has 5 lakh 6% debentures. The overall capitalization rate is 10%. Okay, calculate cost of equity according to the net operating income approach. That is only they have given this overall capitalization rate. This why? Because they are telling us to find as per NOI approach, net operating income approach. Okay, in that case, what is constant? KO remains constant. And they have already given me my KO, which is equal to 10%. Fine. Chalo. Net income, net operating income is 1 lakh minus interest. Interest is going to be 6% on 5 lakhs, which is 30,000. So 70,000 will be the net profit for equity shareholders. Okay, now KO they have given me is 10%. Okay, KO is generally, the formula is NPBIT, a net operating profit, upon the market value of the firm. Okay, KO. Now market value of the firm I can find. NPBIT is how much? 1 lakh. KO they have given me, it is 10%. So this is going to become 10 lakhs. I know the market value of the firm. I also know the market value of my debt. Okay, market value of my debt is nothing but I just paid them the interest. No, interest is 30,000. Okay, upon 6%. It's going to come 5 lakhs. You don't need to calculate it again. The same thing, 5 lakhs rupees over here. Market value of the debt and market value of the firm, both are there. Therefore, market value of equity will be 10 lakhs minus 5 lakhs, which is going to be 5 lakhs. Market value of equity is sorted. Therefore, KE is going to be net profit for equity shareholders. We just found it is 70,000. Okay, upon market value of equity is 5 lakhs into 100. This is going to come as 14%. Clear? We have to just remember in which approach what is constant, and then based on that the sum is solved very, very quickly and easily. Okay. Now question number 4. A company PQR Limited, EBIT of rupees 2 lakhs, expected return on its investment is 12%. What is the total value of the firm according to the Modigliani and Miller approach? Now M&M approach, okay, value of the firm, value of firm. Okay, or you can say total value of the firm. Market value of the firm is nothing but EBIT upon return on investment. Now in my this particular sum, they have given me EBIT of rupees 2 lakhs. Expected return on my investment also they have given to me 12%. Therefore, market value of the firm is going to be 16,66,667. This is your answer. So simple. Directly EBIT upon the expected return on investment. That's it. Okay. Now last one. A firm has EBIT of 550,000. Market value of the debt is 80 and overall capitalization rate is 20%. Find the market value of equity under NOI approach. Okay, fine. So here they have given me EBIT 50, market value of debt already calculated. Okay, KO is 20%. Okay. KO is equal to 20%. Market value of the debt is given to me 80,000 and EBIT is given to me as 50,000. Okay. KO is constant. Now KO is generally what? NP BIT upon the market value of the firm. Okay, I do not know my market value of the firm. So NPBIT 50,000 they have given me upon 20%. That is going to make it 2,50,000. Sorry. Yeah, correct. 2,50,000. Okay. Market value of the firm I have as 2,50,000. Market value of debt I have. Therefore, market value of equity will be market value of the firm minus market value of the debt. 2,50,000 minus 80,000. This is going to be 1,70,000 will be the market value of the equity. Okay, market value of equity only they have asked. That's it. Okay, they are not asking you equity capitalization rate. Alright. So this is it with capital structure. Okay, all the theories and the approaches of capital structure. I hope this is helpful to you all in case of your revision and solving the sums, etc. All the important exam questions I have covered. The rest ones are the theory, and ones which are other ones which are also there, they are same repetitive with the different figures. Okay. Now I want to start with dividend policy. Just give me 5 minutes. I am going to start with dividend policy. Okay. All right. Thank you. Hi everybody. Come on now. Break time done. We are starting with the next chapter, dividend policy. Okay, this will be a quick session. Okay, it will get over fast because it's a very small chapter, dividend policy, and whatever is important from the exam point of view, I'm going to explain you all and help you and solve those sums. Okay. Now, in case of dividend policy, basically we have to understand what is this chapter about. They are talking about distribution of profits in form of dividend. Distribution of profits in form of dividend to our equity shareholders in form of dividend. Now, a company, okay, they have to come up with the best dividend policy in order to know that what should be the percentage of dividend or what should be the dividend payout ratio. Now, say for example, the earning per share, okay, of the company with the help of our income statement when we arrive at earning per share, say it comes to rupees 10. Okay, now from that rupees 10, the company wants to keep some amount, say in reserves, 50% in reserve, and then 50% they want to declare it as a dividend. Okay, that has to be decided. Then they have to come up with the best dividend policy in that case. Okay, in order to know which will be the best dividend policy, there are two theories. Okay, in financial management, two theories. One is dividend relevance theory, and one is about dividend irrelevance theory. Now, dividend relevance theory is given by Walter and Gordon. They are saying that the amount, okay, and the dividend declared and given by a given firm or given company affects the price of that particular company. Okay, so if a dividend is given, dividend is declared, it is relevant to the price. It is going to affect the price. Okay, so they have given up certain assumptions. They have also given up certain rules of their theory that if this particular thing is existing, that this should be the best dividend policy. Opposite of that is dividend irrelevance theory, wherein Miller and Modigliani he is saying that whether you give dividend or you do not give dividend, you pay, you don't pay, declare, don't declare, whatever can be the situation, the price does not change. Okay, so these two theories. So basically, we are going to do three different types of formulas based on this, in which we will be able to ascertain that whether a dividend policy is the best one or not. Okay, so how we will ascertain that? We will ascertain with the help of finding the price. Okay, in both. He is saying the price is not going to get affected. M&M. Walter and Gordon are saying that based on your dividend, price is going to get affected. Let's see how. Okay, so there are two approaches. Now coming to the first approach, Walter's approach. Okay, Walter has propounded the theory, and according to him, he is saying that, see, now there are return which we are getting. As say, suppose I am a shareholder, I am expecting a particular return from my company. Okay, so I am a shareholder of an ABC Limited and I am going to get some return from them. Okay, so say that rate of return. Okay, R, internal rate of return. Internal means belonging only to that company, ABC Limited, say. My ABC Limited's internal rate of return, okay, say is 10%. Okay, the same type of company with the same level and the percentage of work done by them, and in all the aspects they are same. There is one more company, or in the market I can say, there is a expected rate of return internally to hai. Okay, but also as compared with the market competence, okay, the competence, okay, they are giving K is the outside rate of return, or you can say the competitors rate of return, outside rate of return given by our competitors in the market. Okay, so what is Walter saying? That if your internal rate of return, you as a company are able to generate more than outside, then give the least dividend. Give the least dividend. Why? Because see, as it is, we are generating more return. So shareholders are already happy with us. Give least dividend. Keep more money in the balances, in the reserves, and then use that for the growth. Okay, that is what he is saying. But say, suppose if the internal rate of return is less than the outside rate of return, then how will you keep the shareholders happy? Then you give them maximum dividend. Give them maximum dividend at that time. Okay, so that they will not move out from the company. Give that time the maximum dividend. And if R and K both are same, then any proportion of dividend you can declare. Okay, you can declare whatever amount you want to or whatever percentage of dividend payout you want to do as a company. Okay, so keeping this three analysis in mind, we have supposed to, these are the three important rules. If we will follow these three important rules, our share price will be the maximum. Okay, so how will we find the price? Price will be nothing but it is D plus R into E minus D upon K, the whole thing upon K. Now in that P is the price, D is our dividend per share, R is our internal rate of return or return on equity, K is outside rate of return or the cost of capital, and E is the earning per share. Okay, we need to remember this. Basically, this formula is of the cost of capital only, wherein where we were doing KE is equal to dividend, okay, upon price. Okay, D1 upon price we were doing plus growth. Okay, so it is derived from the same formula only. Okay, I will not go into the derivation of the formula. But if you will see this, I am going to get dividend. I am also going to get some capital gains upon the price. Capital gains is basically what, the price which is there. I'm going to get dividends, so of course I'm going to get, but capital gain means today the price is 120. Last year it was 100. So I'm going to get that extra amount. Okay. That extra return I'm going to get, and that I have to multiply with my internal rate of return, divide by the outside rate of return, the whole thing upon K. But if I will remember this formula, it is going to become very easy. Okay, dividend plus R into E minus D upon K, the whole thing upon K. Okay, let's solve one sum. Here. Details are given of three companies A, B and C. They have given us the internal rate of return R. Cost of equity capital is also given, or outside rate of return K is also given to us, and earning per share is also provided. Calculate the price when the dividend payout ratio in first is 50%, 75% and 25%. Okay, in all the three scenarios we have defined. Okay, so A, B and C. Very simple this is. Okay, R is equal to, in case of A, just I am writing given quickly. R is 15%. Here R is 5%. And here R is equal to 10%. Okay. Then we have a K. K is the same, 10% everywhere. Okay. And then we have our earning per share. Again, it is the same, 8 rupees. Okay. 8 rupees earning per share. Okay. Now we have to find the price using Walter's model, and three different situations they have given. Three different dividend payout ratios they are given. Okay. So now I am doing the first dividend payout ratio, which is 50%. Okay, so first one, dividend payout ratio is equal to 50%. Okay, that means out of the earnings of 8 rupees, 4 rupees is going to go as in the form of a dividend. So here in that case, price will be equal to, I'm going to apply this formula. Okay, I'm writing it over here. Price will be equal to dividend plus the whole thing upon K. Right. So just putting it in over here. So here it is going to be, D will be 4 rupees. No? Dividend payout ratio is 50%. Therefore 4 rupees in the first case. So 4 rupees plus R is 15%, E is 8, D is 4, K is 10%, the whole thing divided by 10%. Here I am going to do the same thing again, 4%, 4 rupees plus the internal rate of return here is only 5%. 8 minus 4 upon 10%, the whole thing divided by 10%. And here it will be 4 plus internal rate of return is 10%, 8 minus 4 upon 10%, the whole thing divided by 10%. Okay. Now, just solving this. Okay. Do it in the form of percentage only and solve. Okay. So it will be, when you will solve this, it will be 4 plus 15% of 4. It will be 0.6 upon 10%. The whole thing upon 10%. I'm solving this one. And then 0.6 divided by 10%. This will become 4 plus 6 upon 10%. So here 10 divided by 10%. This is going to be 100. Solve it in the same manner. Here your answer will be rupees 60 and here the answer will be rupees 80. So in case of the dividend payout ratio where it is 50%, okay, see this 100, 60 and 80. Okay. Now if you see, if we are following the rules, okay, of Walter, wherein he is saying that where your internal rate of return is greater than the outside rate of return, give the least dividend. So let's see, where is that? My internal rate of return is greater here than the outside rate of return. Here my internal rate of return is less than the outside rate of return, and here it is the same. Okay. So now dividend payout ratio at 50% I have done. I have to do it with the help now with dividend payout ratio 75% and 25%. So we have to solve it in the same manner. Okay. So when you will apply this formula, here it is coming 100. Price is 100. Here it is 60. And here it is 80. Now second one where your dividend payout ratio is 75%. When you will apply the same formula, 75% of 8 rupees is going to be rupees 6. Okay. So it will be your dividend will be 6 plus 15% of 8 minus 6 upon 10% into the whole thing upon 10%. Okay. Similarly here 6 plus 5%, 8 minus 6 upon 10%, the whole thing upon 10%. And here again 6 plus 10%, 8 minus 6 upon 10 divided by 10, cost of capital, cost of equity. In this case, you will get answer as rupees 90, here rupees 70 and here rupees 80. Okay, and in the last one where the dividend payout ratio is only 25%, okay, of rupees 8. So 8 into 25% is going to be rupees 2. Dividend will be 2. When you will solve it, here you will get 110. Okay, just put the formula and solve it again. Here you will get rupees 50 and here you will get it rupees 80. Okay, so now if you analyze it, okay, I'm just making it a little smaller. Okay, now if you analyze it and see the last one, where R and K are same, in all the three situations, come what may be the dividend, 80 rupees is my price. When the dividend was 50%, 75% or 25%. But where my internal rate of return was less than the outside rate of return, Walter is saying give maximum dividend. Okay, so where the maximum dividend is 75%. Okay, so 75% is the second situation. See, my price of the share is highest in my second situation. And where R is greater than K, okay, then he's saying give the least dividend. So at the time of the least dividend is only 2. My share price is higher. Okay, so this is what Walter has to say about the dividend policy. Okay, now coming to the second model, which is Gordon's. He is also telling us the same thing, but a little bit in a different form. Okay, he is using different words, but giving almost the same rules. Okay, there is nothing which is new in this. Now here he is saying that if your R is greater than K, that means my internal rate of return, I'm generating more than what others are generating in the market, then I should retain maximum. Retain maximum means give least dividend. Only when I will give less dividend, I'm trying to retain maximum. Same thing. When R is less than K, internal rate of return is less, then retain minimum. When I'll retain minimum means I will pay maximum dividend. And if R and A are same, then whatever company does in any situation, the price is going to remain the same. So if we are going to follow these three rules, then our price will be maximum. So here he is given the formula of the price as earning into 1 minus B. Okay, where B is nothing but the balance transfer to reserve. Divide by cost of equity minus growth rate. Now growth rate is basically B into R. This growth rate is nothing but balance transferred to reserve, whatever percentage they have given, into the rate of return. Why? Because whatever reserves are there, at the later stage it is going to belong to the equity shareholders and they are going to generate return again on that. So I am multiplying my internal rate of return with the balance which is there with the company. Okay. So this is about the Gordon model. We'll just solve the sum. Okay. Calculate the market price of a share of ABC Limited as under. No, I will first solve the only Gordon model. Question number 3 here. Okay, KE is 15%. Earning per share is 30 rupees. And internal rate of return is 14, 15 and 16. You are required to calculate the market price of the share as per Gordon's model if balance transfer to reserve is 40%, 60% and 80%. Okay. What am I going to do is first I'm just going to write the formula of the price over here as per Gordon's model. It is nothing but E into 1 minus balance transfer to reserve upon KE minus BR. Okay. Balance transfer to reserve into internal rate of return. This is what I am going to do. Now, there are three situations. R is equal to 14%, R is equal to 15% and R is equal to 16%. Okay, KE is equal to 15% everywhere. Okay. Earning per share is also given to us 30 rupees and then the balance transferred to reserve is also there. Now say balance transferred to reserve, the first one I am doing. Okay, where B is 40%. So when I apply the formula, Earning per share is 30. 1 minus balance transfer to reserve percentage is 40%. KE is 15%. Minus I will do balance transfer to reserve 40% into internal rate of return. Okay. So basically here how will you solve is, I'll show you. 1 second. Okay. Okay. So now this is 31 minus 40%. KE is 15%. And here it will be 40% into 15%. And again 31 minus 40% upon 15% KE minus sign here I forgot, minus 40% into 15%. And here also you can do it as 40% into 16%. No? Yeah, it is given 16%. Okay. When you will calculate this, it will come to 18 upon 0.094. Calculate it in form of points. Simple. 40% is 0.4, 15% is 0.15. Calculate it in form of points and you will not go wrong. Okay, so please see to it that you calculate everything properly. Here it will be again 18. This will be 0.09 and this will be 0.086. So your price is going to be 191.49 or 50 approximately. Here it is going to be rupees 200 and here rupees 209.31. Okay, so when balance transfer to reserve is 40%, in that case our prices are 19,200 and 191, 200 and 209. Similarly, we will do for balance transfer to reserve is 60%. Okay, so when you do that 60%, you have to apply the same formula. You are going to get the price as rupees 181.82. Okay, apply the same formula and solve it. Only the percentage of D will change. Okay, instead of 40, I did on top 40, here it will become 60%. Okay, so everywhere you have to change that. In the second case, it will be 200. In the last one, it will be 222.22. And where the balance transfer to reserve is 80%, the price is going to be 157.89. Here it is going to be 200 and here it is going to be 272.73. Okay. So in all the three situations, you have to apply the same formula. Try to solve in a point form. You will get the correct answer. Okay. So now if you see where R and K are same, price remains the same. No change at all. No change, Price is remaining the same. Okay. So there is no change at all in the price in second situation. Why? Because R and K are same. Now where R is less than K in the first situation, internal rate of return is less, then they are saying that you should retain the minimum. So retain minimum, that means 40% is the minimum. See, the price is highest over here. And where R is greater than K, R is greater than K, then he is saying retain maximum. So maximum is 80%, so price is high in the last situation. Okay, so Walter and Gordon almost the same thing, but you will have to use the formula based on what information is given to you. Generally, they are being very direct. They are directly asking you solve and calculate the price as per Walter, as per Gordon. They are definitely telling you that, or as per M&M. Okay, but in case if they don't, they will give you such figures and such percentage based on which you will know that which formula you have to apply. Okay. Now, last one is M&M model. Here he is saying that whatever you do, a company, whether they give dividend or they do not declare dividend, okay, the price is not going to get affected. Okay, why so? See, what happens is, say tomorrow if I pay dividend, okay, company has already paid the dividend. In that case, the amount which the company could have saved and kept it with themselves is gone. Dividend paid and no retain. Okay, amount is gone. That amount I could have used in order to put into my other investment purposes or expansion purposes. Correct. So now today if I have given XYZ amount of dividend and tomorrow I need more investments. So now what will I have to do is I'll have to issue more shares. Okay, I have to raise capital. From where will I bring money? So here M&M is saying that see price formula is very simple. P1, okay, is nothing but your existing price into 1 plus the return cost of capital minus the dividend. Okay, this M is the additional number of shares. Additional number of shares for the new investment purpose. So how many additional shares I will need depending on what investment I want to do. Also I have already given the remove from that the E. Okay, the earning per share. Also remove that dividend into number of shares on which I have given the dividend upon that particular price which I have already found. I will get the number of shares. Okay, and then when I want to make a fresh issue, I will be multiplying that and getting the number of amount required as per my investment. Okay, so here in the last situation, this becomes the market value of the firm. Please take this 1 plus KE below. This becomes the market value of the firm. Okay, the existing number of shares plus the additional shares at the price which I issued minus my investment minus my plus the earnings per share 1 plus K. Now all these formulas you might find it little difficult as to how to remember, but just make a note of it. Try to practice it in the sum which we will solve. That will also make it easier for you to remember. Okay. Now see this particular question. Following are the details of ABC Limited. They have given me the capitalization rate K 10%, 1 lakh shares of rupees 100 each, already existing shares are there. They are contemplating a declaration of dividend of rupees 6 per share. Answer the following points. What is the price at the end of the year if dividend is not declared? Okay, with all this situation, say dividend not declared. They are asking me price of the share at the end of the year. That means they are asking me the price P1. So in that case, my P1 as per the formula of M&M, P1 is PO, the current existing price, plus the return minus the D1. Okay, now existing price right now is 100 rupees. KE, capitalization rate, is 10%. And dividend declared is rupees 6. Okay, so here when you will solve it, you will get 104 rupees when dividend was not declared. And when dividend is declared, then again P1 is nothing but existing price 1 plus the return, okay, capitalization rate minus D1. P0 is 100, 1 plus KE is 10%, and dividend is declared at rupees, sorry, here it was dividend not declared, no? Dividend is not declared. So this will become 0. Dividend is not declared. In that case, your price is going to be 110. When dividend is not declared, that means D is 0. This is going to be 110. Here dividend is declared of 6 rupees. Here the price is going to be rupees 104. Now to the extent of the dividend being declared, I might need new additional shares to be raised. Now how will I find that out? Okay. Now see this. This is of the dividend declared, no? Okay. Price I have found. Now M will be the investment needed minus earning minus N into D1. Okay. This just put it in the bracket. The whole thing upon P1, the price. Current price now which it is running at. Okay. How much is the new investment needed? Okay, 1, 2, both these are already found. Okay, all these 2 questions are answered. Assuming the firm has a net income of rupees 10 lakhs and makes a new investment of rupees 20 lakhs, how many new shares must be issued? So this is what I am trying to find out. So they want investment of rupees 20 lakhs. Okay, their earnings is rupees 10 lakhs. 20 lakhs, 10 lakhs minus the existing number of shares. Okay, existing number of shares are how many? 1 lakh shares into the dividend. So I'll write it in full numbers only. My investment amount is 20 lakhs, additional investment. My earnings is 10 lakhs. And dividend which I have declared of 6 rupees on 1 lakh shares, 6 lakhs. Okay, the whole thing upon price. Price when dividend is declared, this is not declared, no? Okay. So when the dividend is not declared, in that case my price was 110. Okay, so your number of shares 9091. Same formula I will put. M is equal to investment earnings minus the dividend declared upon the P1. What is going to change? Everything on top is going to remain the same. 20 lakhs minus 10 lakhs. Okay. Minus 6 lakhs. The whole thing upon price over here is 104. Okay, so here the number of shares, new shares to be issued will become 15,385. Okay, this is going to be 0. Dividend is not declared here. Okay, so now you see when the dividend was not declared, the number of additional shares was 9,000 only for a future investment which I needed. But when I declared the dividend, I had to increase my number of new shares to 15,385. Okay, so now eventually what happened? Okay, to the market value. Now say if you want to find out the market value of the firm, then you have to multiply all this and you can get the market value dividing by the giving formula, but that is not very important. That is why I am not going into this. This is the market value of the firm. Okay, but the existing number of shares, if I am telling you today that it is going to be 15,385, that means what will be the amount? It will be 15,385 into 104, no? Because that is the price which is running. So it will be so much of amount will be as the new investment. Okay. Now let's start and do a past exam questions. Okay, which are very easy and they do not run into so many additional formulas. They are only based on Walter's model, Gordon's model, and M&M model, based on finding upon the price. Okay, everything is based on finding the price. See, now earning per share of the company is rupees 10. Internal rate of return R is 15%, and capitalization rate, that means K, is equal to 12.5%. If we are using Walter's model, then what should be the price of a share at an optimum payout? Now, since R is more than K, R is more than K, then he has told that give least dividend. Okay, we'll give least dividend. Now, how much least dividend? I will assume dividend to be 0. Least 0. Okay, so your price as per the Walter's model. Now you'll see the MCQs are very easy. Walter's model have to just apply the formula D plus internal rate of return, earning per share minus the dividend upon K, the whole thing upon K. Right? I am telling you that they want to declare least dividend. Dividend will be 0. R is 15%. Earning per share they have given me 10. Dividend I am saying it will be 0. And K is how much? 12.5%. The whole thing upon 12.5%. Okay. So here you will do 0. Fine, you can just remove the 0. 15% of 10 will be 1.5 divided by 12.5%. The whole thing divided by 12.5%. Okay, so this will come to 12 upon 12.5%, which will be rupees 96. 96 will be the answer. So if there will be least dividend, dividend will be 0. Share price will be at the maximum, it will be rupees 96. Okay. Now the next sum. From the following information, find the market value, okay, price value per share as per the Walter's model. Earning of the company is 5 lakhs. Dividend payout ratio 60%, and number of shares which are outstanding is 1 lakh. Equity capitalization rate is 12%, and return of investment, rate of return on investment is 15%. Okay, so now earnings is equal to 5 lakhs rupees. Divide that by number of shares, N. 1 lakh shares. Therefore, earning per share is going to be 5 rupees. Okay. Dividend payout ratio is going to be 60%. Okay. K over here is equal to 12%, and internal rate of return R is 15%. Everything is given. I have to just put it in the formula. P is D plus R into E minus D upon K, the whole thing upon K. So dividend is 60% of 5 rupees, which will be 3 rupees. So 3 plus internal rate of return is 15%, earning per share 5, dividend 3, outside rate of return is 12%, the whole thing upon 12%. When you will solve this completely, you will come to 3 plus 2.5 upon 12%, which is going to give you rupees 45.80. Okay. Now coming to Gordon's model, determine the market price of the share of XYZ Limited as per Gordon model. Equity capitalization rate. Expected earning. Okay. Earning per share rupees 20. Rate of return on the investment is 10% and retention ratio B is 30%. Once you write all the givens, keeping the formula in mind, you have to then just apply the formula. That's it. So price will be nothing but E1 minus balance transfer to reserve, the whole thing upon KE minus B into R. Okay. Earning per share is rupees 20. They have already given me 20%. 20 rupees. Okay. So 21 minus balance transfer to reserve is 30%. KE is 11% minus 30% into 10%. Okay. This will be 20 into 0.07. This will be 11% minus 3%. Okay. It will be 10% of 30. You can do that. So 11% minus 3% is 8%. So 20 into 0.7 is 14 upon 8%. This will give you rupees 175. Your maths has to be a little better, okay, while solving FM sums. Practice it. Okay. Next one. Okay. Investor is holding 100 shares. Current rate of dividend paid by the company is rupees 10. Dividend is rupees 10. The long-term growth rate is expected to be 10% and expected rate of return is 20%. Expected is 20%. The long-term growth rate internal is 10%. Current market price of the share is how much? Now, only these three things are given. So, we will apply a normal price formula, which is nothing but D1 upon KE minus G. The KE formula which we used to do, cost of capital, if you all remember, cost of capital one formula was based on dividend plus growth, D1 upon the price, okay, plus the growth. Okay, so here we have just taken the price on top and brought the KE down and the G down. Okay, now this is like going to be a arriving of the formula, but you have to just do simply price is nothing but D1. Now D1 will be what? 10 rupees they have already declared the dividend. And with the growth 10%. Okay, so 10 plus 10% you will have to do. Do that 10 plus 10%. See, you will get 11 as an answer. 10 plus 10%. So 11. And KE is, they have given me KE as 20%. Minus G is growth rate, internal growth rate is 10%. So this is going to be 11 upon 10%, which is going to be rupees 110. These sums are also asked in MCQ. So please make a note of it, solve it properly. Now the last sum which I have taken from the past exam questions. A company has 5,000 shares of rupees 100 each. Capitalization rate is 12%. Okay. Income before tax is 2 lakhs. Tax rate is 30%. Dividend payout ratio 50%. Find the market price of the share at the end of the current year based on M&M approach if dividend is paid. Okay, fine. So earnings before tax is 2 lakhs. I'm just trying to find the earnings per share first. Minus the tax rate, which is at the rate of 30% of 2 lakhs. So this will be 60,000 and 1,40,000 will be the profit for equity shareholders. Okay, profit for distribution or for equity shareholders. Now, how many shares are there? There are some 5,000 shares. Okay, so divide that by number of shares 5,000. You will get earning per share as rupees 28. In that, dividend payout ratio is 50%. So 14 rupees. Okay, so I know my dividend payout ratio, I know my earning per share. I have to find the price. Price will be nothing but the current price 1 plus KE minus the dividend. So the current price is rupees 100. KE they have given me 12% minus the dividend is 14 rupees. Okay. 100 into 1 plus 1.12 minus 14. This will be 112 minus 14. 98 rupees is the price of the share as per M&M approach. It is so simple. All your M&M approaches are talking only about finding the price of the share in your past exam questions. Okay, so this was it with dividend policy and capital structure. I hope you all find this video very helpful. Please go through it, make a note of these solving sums. Okay, they are going to help you a lot. These solutions, if you all have made a note of it, the practice questions which I have solved before solving the past exam questions, make a note of it so that you can revise it again in case if you want to. Okay, and try to see that if you can practice a few more MCQs in the form of practical and theory, and now you'll be able to attempt it. Okay, so thank you for being there, and do not forget again to please subscribe to our Jahangir tutorials channel. Okay, we also have an app of Jahangir tutorials. You can even download that. So kindly subscribe to our channel so that you can get all the updates and you can stay tuned, for all the future videos and revision lectures which I am going to come up with, even in FM and also for corporate and management accounts. Okay, so we have our WhatsApp group, we have our Telegram group. Kindly join those groups. We have given the description below. Okay, join these groups, and you can also, if you have any doubts, any personal queries regarding your CS, etc., you can even get in touch with me on my Instagram account, CS Fatema Kagalwala. Okay, so see you all again soon. All the very best. Bye bye.